Welcome to the Greed Geek Podcast with your host, Jason Fern.
What is up, everybody, and welcome to episode 5 of the Greed Geek Podcast. This week, we're going to talk about strategies for new investors. We'll go over how to get started with your portfolio and methods to evaluate companies to pick those big winners. I'm very excited to welcome in my guest today, Zac Hartley. He is someone whose advice I've been following very closely these past few weeks on his YouTube channel, which has been accelerating in popularity. Zac is a graduate of Mount Royal University. He is a successful entrepreneur. He's a former CEO. And he has successfully pitched on the Dragon's Den, which is the Canadian version of the Shark Tank, which is very exciting to me since I love Shark Tank so much. And today, he's a stock trader and investor with tens of thousands of followers. Zac, welcome to the show.
Jason, thank you so much for having me. I'm really excited.
I would love to hear a bit about your history. Like, how did you get started in this road to business and entrepreneurship?
Yeah, so it's been kind of a long road for me. I started off kind of in high school trying to figure out what I wanted to do. It sort of hit me that I didn't want to go into the arts and I didn't want to do anything really fluffy. I wanted to get in and actually go through university and come out with a degree. And so I decided to settle on business. And I got pretty lucky because I ended up at Mount Royal University, where they have just a fantastic entrepreneurship program. And during my last year at Mount Royal, I ended up starting a business called Burgundy Oak, where we manufactured furniture and a variety of other products out of wine barrels. And so I got a nice little kickstart, basically getting that business up and off the ground at Mount Royal University. They really helped me out there. And then since then, I kind of basically built it up a little bit. We pitched on Dragon's Den in 2018, like you mentioned. We successfully raised some money there, and we were able to walk out of the den with a deal with actually 3 of the dragons, which is absolutely amazing. So if anybody wants to see that, they can just kind of look it up on Dragon's Den online. And that was really exciting because it kind of gave us the foundation that we needed. And then we built the business a little bit further, and we got pretty lucky right before COVID hit, because we ended up selling off a bunch of the assets from the business. And then from there, I started my YouTube channel, basically kind of explaining how my investments work and how my philosophy around investing, or at least how I think about it. And that's really what's taken off recently. So started in university with my own business, kind of grew it up over a few years. And now after the exit from there, I'm just kind of managing my own money, trying to build my own portfolio and help new traders as well.
That's awesome. I got to ask you, like, starting off your new business, I know a little bit about your history, and you guys just saw an opportunity out of just kind of organic things that your family was doing together. Can you tell us a little bit about that?
Yeah, exactly. So my family was vacationing in British Columbia. Up here in Canada, that's kind of our vacation zone. And we were out on vacation, and we wanted to do some smoked meat and make some smoked chicken and some tacos. And we didn't have a smoker, and we didn't want to go just buy one, but we were in the middle of wine country, and we had a couple barrels around. So we decided to convert one barrel into a smoker that we could use to make dinner with for everybody at the cabin. And it really took off. It worked so well. I ended up making one back at home. I made one in the garage. And then I posted a couple of photos about it online, just kind of shared it around. And the editor at our local news station saw it and said, "Hey, we want to come in and do a story about you." And I live in Calgary, and at the time, oil, the price of a barrel of oil, had just fell from $110 to around $25. And so they were looking for some good news stories, and luckily I could provide it at the time. And so they came in and they did a little news story about this single barrel smoker that I built in my garage and kind of played it off like it was a real business. They believed it and came in and did a story on us, and we sold like 5 smokers that first day. And then it was kind of like, okay, let's hit the ground running. Let's buy a couple more barrels and let's get started from there. And that was literally how the business started. That was in my 4th year at Mount Royal. And then Mount Royal University, they did a pitch competition there where I won about $20,000 to kind of get the business up and running. And then 2 years later, we walked out of Dragon's Den with about a $500,000 deal. So it worked out really well.
They say fake it till you make it. And I guess that's what you guys did, right?
Yeah. Honestly, if you can fake it till you make it, but you have a little bit of content, you have some confidence, and you have a foundation of what you're doing, I think that's the best advice you can give or get.
And so you made the transition in the past year from running that business to this YouTube channel, and you've gotten some quick momentum, and you've got quite a few followers now. You made some really good picks. Tell us about that journey to turn into a YouTuber.
Yeah, the YouTube journey has been a lot of fun. So we kind of ended the business, and then I was sitting at home, and quarantine hit and lockdown hit here in Canada, and we couldn't really go out. And so I'm sitting at my computer for most of the day making my own investments or my own trades or doing my own research. And I thought, I wonder if anybody else wants to see this, or if anybody else can learn from this. And then at least I'm helping somebody else while I'm doing the work anyway. So if I'm going to do it regardless for my own investments, maybe somebody else will see some value in it. So that was the original idea. And I did a couple of videos, and a lot of people reached out and said, hey, this is super helpful. So what I did after that was I took all of the content that I learned in university. So literally my stock market fundamentals course that I took in university, I put it into a video series that I made sitting at home right here in April and March during the lockdown last year. And I posted it to Skillshare. And Skillshare is really cool because it's basically like the Netflix of online courses. And so I now have my course on Skillshare that walks people through the step-by-step methodology that I use to invest and to trade. And it's really great because Skillshare gives everybody a 2-week free trial. And so somebody can take my entire course completely free, cancel their subscription on Skillshare, and then they basically, I like to think of it as the equivalent of the stock market course that I took in university and paid a whole lot of money for. I basically condensed all that content into a 9-hour course on Skillshare. Obviously, the university wouldn't agree with that statement at all, but so that's what I'm doing now. So the YouTube channel, and then I have a lot of my content on Skillshare, and it's grown just dramatically. And YouTube has been phenomenal because it gives everybody else the ability to give you a test. They can see, do they like this guy? Does he make any sense? And then over a couple of months, they can actually see the results of this guy's stock picks or his advice or what he's doing. And luckily, I think the value that I've provided on YouTube and the skills and the teachings, at least some people have seen value in that, and they've clicked the like button and they've watched the videos, and YouTube has seen that. And now YouTube's pushing my videos to more and more people, and the channel's starting to grow pretty quick. So it's been a very exciting experience. It's worked out 10 times better than I thought it ever would. And YouTube has been a phenomenal change in my life.
That's great. I mean, it doesn't hurt that you've made such good picks over the past few months, right? You've had some crazy returns.
I've gotten pretty lucky. I've made some pretty good picks. I got in very, very early into some of the psychedelic stocks. I got in very early into a couple of the drone stocks, and some of my tech plays are doing well as well. So yeah, I've done very well over the last few months.
Well, let's talk about what's going on in investing in general. What I've noticed is that a lot of my friends who had no interest in investing, a couple months ago, all of a sudden are really interested. I'm not totally sure if it's GameStop or it's Bitcoin or a little bit of both, but what do you make of this kind of what I call a retail investor revolution?
I think you just nailed it on the head. I think that we're seeing a fundamental shift in power where all of the money was held by a small group of people. And now the majority of the money in the market is probably being held by retail investors spread out across the country, depending where you are. So I think that shift of power is causing a little bit of change in the larger markets, like what we saw with GameStop. I think it's absolutely fantastic that individual people are now taking control of their personal finances and trying to learn how to invest. And as long as they can actually understand the knowledge and the system that they're investing in, I think that's great. I think as a retail investor, the number one thing you should focus on is educating yourself instead of trying to get big returns, especially in the beginning. But I think the fact that more and more people are getting into investing is definitely a good thing. More and more people are becoming retail investors. I personally think that's a good thing. And I've seen it in my personal numbers. When I started the YouTube channel, it was pretty slow growth, but I can tell you as soon as the GameStop drama happened, I saw a pretty dramatic spike in both my viewership on YouTube as well as the course signups, because people are getting into the market, but the stock market's complicated. There's a lot going on there. It can be overwhelming when you just get into it. And so education, not so much on how to trade, but how the market works so that you can understand it, is definitely the most important thing for new traders, for new investors.
I mean, I agree in the sense that we got people off the bench, and that's the important thing. You got to take your future into your own hands. But one thing I worry about is, a lot of them are kind of, at this point at least, are just kind of cheerleaders and just like hoping the stocks go up, and they don't know exactly why they're picking it. Is there also some risk in people losing a lot of money and maybe that being a bad thing long term?
Yeah, I think there's definitely that risk. And you've obviously seen that with people that tried to get into GameStop and then lost a ton of money because that was, let's say, their first trade or their first 1 to 10 trades. And it's just not a good situation. So yeah, there's definitely some risk there. And I think what I've even seen is my friends starting to get into it. They open a Robinhood or a Wealthsimple or a Webull account, and then they come to me and say, "Hey, Zach, what should I be investing in?" And the real question they should be asking themselves is, what type of investor am I? Am I a long-term buy and hold investor? Am I a swing trader that's going to hold stocks for 1 day to 6 months? Or am I going to be a day trader and I'm going to enter and exit positions in the same day? Like, those are kind of three different categories of people in the stock market. And I think it really, really helps if you can figure out which one of those you are ahead of time. Because if you're just going around asking people what stocks to trade, or you're looking for people on Facebook or YouTube to tell you which stocks, you're probably not going to be able to build the right portfolio. But if you can say, here's me, I'm a long-term investor. I believe in these industries and I don't believe in these industries. And I like this type of company that pays a dividend or has great cash flow or good growth. Then you can go through and you can filter through the market to figure out what company fits best in your portfolio. And that's going to be a much better strategy and end result than asking your buddy down the street or the guy on Facebook or YouTube what stock you should buy, because he doesn't know what's in your portfolio. He doesn't know what your risk tolerance is, and he doesn't know how long you need. He doesn't know when you need that money back, if it's for retirement or a house or any of those things. And so those are all major factors in investment, which I think a lot of retail traders sometimes skip over because they get pretty excited that they just got the app, they got their three free stocks with Webull, and now they want to go make some crazy returns, which is good. It's great that they're ambitious, but it can be dangerous as well. And the last thing you want to do is start on the wrong foot and lose $200 and then get discouraged about the markets.
$200 is maybe even good.
Yeah.
I'm in a Facebook group right now with some of my buddies who are just getting into it, and some of them have this FOMO thing going on, and they've lost like thousands. Like they're all in, and it's, and a lot of them are also, you heard this HCMC thing, they're pegging their retirement on that. So you got to be careful out there.
Yeah, I put my email underneath my YouTube videos, and unfortunately, I'd say once every 2 weeks, I get one of those panic emails of, "Hey, Zach, here's what my portfolio looks like. I'm holding the bag. What should I do? My family's worried." Like literally in the email, they write that their family or their wife or their son or whatever is disappointed or worried. And it's like, you have to do everything you possibly can to avoid that situation for yourself, because I don't want to get that email either. So
let's talk about that. So, somebody's made a decision to get into the market. They're starting from zero. How should they get started? Should they, do they decide initially which of those they're going to be, or do you think that everybody should kind of start out establishing a long position first before they get into kind of trading?
I think it really depends. I think you need to establish those first, because if you know that you want to be a day trader and you want to try this out and you want to sit down for 4 hours a day every morning and you want to try and be a day trader, then the long-term stuff doesn't really matter to you. Excuse me. And it won't excite you or get you interested. But what you need to do as a new trader that's getting into the market is you need to understand how the market works. What drives the price up and down? How do you actually execute a trade? You need to understand the system that you are getting into. And that only comes through education and practice accounts and actually trying this out. So as a new trader, my recommendation would be figure out what time frame you're looking at. Are you a day trader, a swing trader, or a long-term investor? And then open up a practice account, make 5 or 10 trades so that you understand what it's like to actually execute a trade, see it on the chart and actually do it. And then figure out a strategy and build a strategy, keep track of your trades, and then refine that strategy over time. That should be the goal, is to develop and write out a strategy, test that strategy, and refine it over time. That's how you get better as a trader. But what a lot of people look for is that to get handed a strategy that worked for somebody else, they think it'll work for them, and it never will, because the way that I look at a chart is going to be different than the way that you look at a chart. And so you need to figure out how you are going to trade to meet your own personal financial goals, and then develop a portfolio or a strategy that helps you meet those goals, because the dude on the internet doesn't know your risk tolerance or your lifestyle.
Right. And a lot of people, they're not understanding it, don't have the stomach for the ups and downs either. of some of those riskier type positions. So, I mean, from my perspective, and feel free to disagree, the newbies is probably better off going down to their local investment broker. To me, it's Fidelity, and starting some positions of maybe ETFs and really getting that broad diversity first, and then start playing after that. Do you see it differently?
No, I totally agree with that. Like if you're going to be in the markets for a period of time and you're looking to build a portfolio, ETFs and diversification is your absolute best friend. And the amazing thing about ETFs or exchange traded funds is that now you can buy them in every single industry. So you can buy an ETF that replicates the entire broad market with the S&P 500, but you can also buy an ETF in e-commerce or renewable energy or Bitcoin or psychedelics. Both of those ETFs just launched in the last month. So there's a lot of diversification and a lot of different options in ETFs. And the great thing about those is that you could make 3 or 4 trades and have a fully diversified portfolio in one day. And your entry and exit points hardly matter at all. You're in it, you're ready to go, and you already have a diversified portfolio. So ETFs for a new trader or somebody that's like, let's say you're starting out with a good chunk of money and you're not really sure exactly what to do. And maybe you got a little bit of it that you want to experiment with and play with. The rest of that should be in ETFs without a doubt. Or it should be in a well-diversified portfolio that you're managing and staying on top of.
Yeah. Yeah, I mean, it's so great to be able to buy, one stock and have all the S&P 500 or even the total market ETFs. Or you can ride with Cathie Wood and see what happens. Right now, it's not so hot, but it was going really well, up until a few weeks ago.
Yeah, she's a very smart lady. I think the Tesla fall off over the last week or two has probably hit her pretty hard, but a very smart lady. And I recommend ARK ETFs to all my friends. So I stand behind ARK. I like what she's doing. I think she has some fantastic companies in those portfolios. And I personally recommend ARK to my friends. So I like what she's doing.
Very future thinking.
Yeah.
All right. So next up, I'm curious about how many stocks that you own. Before the show, I was talking about, Jim Cramer says that, he doesn't recommend owning more stocks than you can put an hour into per week. Maybe that's a little on the high end, but I'm curious, like how many individual stocks do you have in your portfolio?
Yeah, I really, I like Jim Cramer. He's a good guy and he's got some good morals and some good foundational teachings. With diversification, there's a couple of studies that have come out that have said anything over 15 to 20 diversified positions and it's diminishing returns, meaning that anything more than 15 or 20 stocks, you're not actually adding a whole lot more diversification to your portfolio. You're just adding a little bit more work. As long as the original 15 positions, let's say, are actually diversified. So for me, like if you applied that rule to Apple and you bought Apple, let's call it 3 years ago, you wouldn't need to spend an hour of research looking at Apple every single week or whatever it is, right? You're comfortable with Apple. So for me, it has to be a number that you can manage. And if you're looking for diversification, there's no point in anything over 20 because it's not going to add more diversification to your portfolio. So you need to be able to manage it. Like, let's say you just love Apple, you believe in Apple, and Apple's your go-to, then 5 or 10% of your portfolio in Apple, you probably don't need to look at that every single week. However, if you're investing into the drone stocks and the psychedelic stock, and that's part of your portfolio, you need to be doing an hour of research on those industries every single week, because just last week, 2 different companies in the drone space had short seller reports come out. So there's a lot going on in those industries that you need to stay on top of. And if you're not on top of that, you can get burned pretty easily. I saved myself about 20% on one of these short seller reports because the report came out. I put a stop loss on my trade at $11, and about 3 hours later, the stock was trading at $8 once everybody had read the report. So you need to be able to stay on top of it in these riskier, volatile industries. But if you have a couple anchor plays in your portfolio, then I wouldn't say you need to research them once a week, but you definitely need to stay on top of the news for 15, 20 minutes on every position. So my thoughts are 15 to 20 positions will give you more than enough diversification, but you do need to be able to manage them or stay on top of them.
And those are outside of the ETFs. These are individual names we're talking about.
Yeah. So if you were doing a portfolio of just stocks, like 15 stocks, 20 stocks is going to give you the maximum amount of diversification. Or if you're holding ETFs, then go buy the S&P 500, go buy a renewable ETF, go buy an e-commerce ETF, and go buy one more that's your absolute favorite, and you'll have the exact same level of diversification as well.
Gotcha. All right. So, the next thing that's getting a lot of attention lately is cryptocurrency. So, we had a big run up and a little bit of a pullback. I'm curious where that fits into your portfolio, if it does at all.
Yeah, so cryptocurrency, I'm bullish on cryptocurrency long term. I am pretty well aware of the volatility and the risks associated with it. And I think other people need to be more aware of the risks associated with it. I want to say Bitcoin's collapsed by 50% at least 4 times in the past, at least 3 or 4 times. So that is within the cards. That is something that can definitely happen. And you need to be well aware of that if you're going into the crypto space. Now, the other thing you need to be well aware of is taxes, because depending on what country you are in, the taxes on crypto is very, very difficult to keep track of and can be a little bit harder to maintain. So in the UK, you're paying taxes, I believe, correct me if I'm wrong, but in the UK, you're paying taxes on the crypto gains as well as the gains on that crypto compared to the fiat currency. So you're paying double taxes on it. And then in the US and Canada, you have to know your average holding cost, which a lot of these softwares and platforms don't provide to you in crypto. And so I think there's a couple of tax things that are going to be need to be worked out with regards to crypto over the future. So for me personally, I don't have direct holdings of Bitcoin or Ethereum or anything, but I do hold 2 or 3 different crypto stocks. Okay. So publicly traded stocks that are completely focused and exposed to the crypto space. I like those because they're giving me better returns than the actual crypto exchange itself. So Bitcoin or Ethereum, I'm getting better returns on the stocks that I'm holding, and the taxes is going to be much easier. And I have tax advantages based on the accounts that I'm holding them in. I won't have to pay capital gains. So I personally am holding crypto by holding publicly traded stocks with exposure to it. I think there's nothing wrong with holding Bitcoin or Ethereum. I think both of them will do well over the long term, but it should not be the weight of your portfolio. It should not be the largest position in your portfolio. It should be a small position in your portfolio, and it's going to be very interesting how it evolves over the next few years, but you need to be prepared for some volatility. I think we're already 10 or 15% down from the highs, but we're still higher than we were in January. So there's a lot going on in the crypto space right now. And I think for me, I actually just prefer the exposure through publicly traded stocks rather than holding the coins. So that's what I've chosen to do.
What kind of percentage do you like to allocate toward that?
I look at it as position sizes within my portfolio. So I look at my crypto stocks the exact same way that I look at any other stock. So I usually start with a small position of 3 to 5% of my portfolio. If I'm confident in it, I will build it up to 6 to 9% of my portfolio. And then I'll usually trim it around 15 to 20% if it really runs up. So I think both of my stocks I've trimmed already or taken a little bit of profit on, but I want to say all 3 of them are 8 to 10% of my portfolio per position at the moment. So I'm probably 20 to 30% exposed.
And are you in Grayscale, or what funds are you in?
I'm in Hut 8, I'm in Hive, and I'm in Route Master, which is now DeFi Holdings. DEFI is the ticker for that one.
Okay, great.
So
we talked a little bit earlier about kind of trying to figure out which you are, a trader or an investor, but you can also be both, right?
Yeah, totally. There's a lot of people that are both traders and investors, and if you look at online on YouTube, you can see a couple of them as well. Like there's a lot of people that have one account that brings in dividends or just holds the long-term blue chip plays, or is their retirement fund, and then they've got 50 G's that they day trade with.
Yeah.
So you can definitely be both. The thing that you need to figure out is when are you going to do which one, and you cannot flip-flop in between them. You cannot be a long-term investor in this account and then all of a sudden you want to make a day trade and you completely blow up your strategy and you go against what you've been testing for the last 3 months. Like I said this at the beginning, and I truly believe this. The difference between good investors, bad investors, traders, day traders, whatever it might be, is their ability to develop a strategy, deploy that strategy, test that strategy, and then refine that strategy. That's how you build yourself out. That's how you make more trades. That's how you figure out and build more confidence into the investments that you make, is based off of past history that you're tracking and that you can adjust and improve on. And so for me, everybody that I talk to, they say, hey, what stock should I buy? What do you think of this stock? And what I like to respond with is, well, what's your strategy? Does it fit in with your strategy? Because I don't know what your strategy is, right? So
Yep.
I think that's the big thing to figure out is build a strategy, test it, and then refine it. Whether you're long-term or short-term, it doesn't matter. But
I think that segmentation of your accounts is key, right? Because you want to be able to see, am I beating the market with my long-term investments? And if you're mixing the two, you really have no idea how you're actually doing.
Exactly. And that's where I'm going with that is like, you need to keep them separate and you can't flip flop between them because then your data overlaps and
Yep.
it's not good data. But if you're a day trader and you make breakout trades and you keep track of how often you're successful on trading breakouts, then you can refine that strategy and figure out, okay, how do I identify a false breakout? How do I correct the ones where I went wrong? And you can refine that strategy over time. But if you're flip flopping between day trading, swing trading, and long-term investing all in the same portfolio, you'll have absolutely no data to refine your strategy on.
Yeah. And I'll mention one of my books I really like is this Jim Cramer's Real Money. And one of the things that he says, and along those same lines, is you can never let a trade become a long, and you can never let a long become a trade. You have to upfront decide which is this and stick with it. They can't flip.
Yeah, and I totally agree with that. Like if you're a long-term investor, you should be able to manage the dips, and you should be looking at those dips as an opportunity to buy Apple stock on sale. But if you're a trader, you should be looking at that dip and saying, I needed to get out as soon as that stock turned around. And
Right.
so the mentality behind a day trader and a long-term investor are completely different. And that's how you build a strategy. That's what a strategy is figuring out those entry and exit points.
Yeah. And even within trading, there's differences of are you that momentum trader just trying to do a quick flip? Like one of my buddies says he doesn't like to hold stocks more than 5 minutes, right? So, but you might also think there's some sort of short-term catalyst that you're gonna catch a wave over, a few weeks. So, always go in with that strategy and know what you're doing and why you're doing it.
Yeah, and I think the most important thing to say, especially for new traders, is that you can be successful in all of these different realms. There's people that do the 5-minute trades. There's people that do the hold for a couple hour trades. There's the swing traders and then there's the long-term investors. And you can find millionaires. You can find people that have been extraordinarily successful at every single different stage there. And so the important thing is figuring out your lifestyle. Do you want to be up at market open every single day, having already done an hour of research and ready to go as soon as that bell opens, in and out? Like, is that your lifestyle? Do you want to be that guy? Or are you more of the, okay, I'm going to wake up at 10 a.m. I'm going to check the computer for an hour. I'm going to make a trade here and there. And then I'm going to do my research for the afternoon. So
Yep.
You need to figure out what lifestyle you want, because day trading is a full-time job and long-term investing is go to the golf course and then
You
find
can go to sleep. Yeah.
right.
Yeah. For me, I use Webull for my day trading, which I've just started a couple months ago, just kind of learning the ropes there. I'm terrible at it right now, but I'm hoping to get good at it. But I've been in Fidelity for, a dozen years, and that's my longs and been very successful there. So, yeah, segmentation is key. So next thing that I want to talk to you about is technicals versus fundamentals.
Mhm.
I am personally not a huge fan of technicals. I think a lot of the YouTube wizards out there look for shapes, and in my mind, it's like looking at clouds and arguing if you see an alligator or a dolphin. Like that's to me what a lot of this technical stuff is. But I appreciate on your show, you strike this really nice balance, because you do talk about technicals, you do look at charts, you do look for resistance signals, but you're also very heavy on the fundamentals. So talk about kind of how you weigh those two things against each other.
Yeah, so I think there's like a great quote. I don't know who said it. I think it was Warren Buffett, but he said, in the short term, the stock market is a voting machine, and in the long term, the stock market is a weighing machine. Meaning that in the short term, people are voting and they're just saying what they like and they're just casting votes. But in the long term, the stock market's going to really weigh out who the winners and losers are. And it's going to be pretty apparent based on what they actually have. And I totally agree with that. And so when I look at fundamentals are the weighing of the stock market. Everything is always going to come back to the fundamentals. If a company cannot generate revenue, it's not worth anything. If they cannot generate profit, it's not worth anything. Even if they're growing, it doesn't matter. If the fundamentals aren't there, the stock price will always come back down to reflect the fundamentals in the long term. In the short term, we're all very aware that that is not always the case. And so in the short term, that's where you can start to use the technical analysis, because unfortunately, we don't get a whole lot of information from the fundamentals very often. You get the financials once every quarter, you get a couple of press releases, and you can manage them. You can look at the management and you can compare some of the ratios, but you don't get daily updates on the fundamentals, but you do on the technical analysis. And so how I look at the technicals, or when I look at a chart, is that chart and that price action is a reflection of people buying and selling in the market. And it's kind of indicators as to what's happening in the market. The same way that the gauges in your car tell you a little bit about the health of your car, that's what the stock charts are for the company. They're not going to tell you exactly what's wrong with it or exactly how great your engine is running, but they'll give you some indicators to say your oil is low or your engine's running hot. And that's what the stock chart is. And so if you can use the technical and the fundamental analysis and combine them and say, I have a fantastic fundamental company here. They have great profit. They have great revenue. The fundamentals look great. And then you can use the technical analysis to identify a good buying opportunity in the short term. That's how you can get the best return. And that's how I like to use them. So I very rarely make a trade based on just the technicals. I have to understand the company, how they make money, what the business model is. I have to actually like the company. Once I've checked that box, then I go into the technicals and I say, okay, based on this chart and based on the stock price and the price action, where can I get in at the best rate? I like the company and I want into it. Am I better off buying now or am I better off waiting? And usually, if you can understand the technicals and what's happening in the chart, you can get a better sense of should I wait or should I buy now? And so technicals are definitely not the end all be all, but they are a reflection of how people feel about the stock. And so that's how I look at it.
And do you use that both for your long positions and your kind of trading positions?
Yeah. I mean, obviously, the trading positions, the shorter time frame you go, the more heavily you rely on the technical analysis. Like day traders don't use fundamentals and long-term investors don't use technical analysis. So
Right.
it's that spectrum of the shorter you go, the more important the technicals are because you can pull more information from it. However, the financials are definitely way more important in the long run than what the price did today or tomorrow. And so
Yeah.
it depends on the position. If it's a long-term position, I'm much more focused on the fundamentals and the company and buying a great company. If it's a short-term trade, I'm much more focused on entry and exit point based on price action.
So those reading of the chart is really a way to, I think, get insight into the psychology of the kind of the macro market, right? Maybe where some of the people are putting in buy and sell orders and things like that.
Exactly. Yeah. So like for instance, the biggest telltale sign when you look at a chart is going to be looking for levels of support and resistance. So what's a good example? If you look at modern meat right now, I want to say it's around $4 that the price has hit $4 like 6 times. It just keeps hitting $4 and falling back down. $4 falling back down. And so what that tells you is that as soon as this hits $4, people are locking in profits. They're locking in profits, they're getting out, and they're basically cashing in, and that's sending the stock price back down. And so what's really interesting is going to be when the stock closes above $4 and it goes to $4.10 and it goes to $4.15 and it closes at $4.15. That means that everybody that was selling at $4 has already sold, and there's going to be less pressure to sell the stock, which is why you might see a breakout. And so when you look at the stock chart, what you're looking for is you're not looking at the candle, you're looking at the guy behind the candle that made that trade. And you're trying to figure out how many people are going to sell at $4. And when the people that are going to sell at $4 runs out, I think there's going to be some major pressure on the stock to go higher. And that's how you capitalize on it.
Yeah, and for anybody whose eyes are glazing over now, and this is a little bit over their head, I just want to stress that as a long-term investor and beginning in this, you don't necessarily have to get obsessed with these things, because if you believe in a company long-term, whether you catch it 50 cents or a dollar lower, it's not going to matter to you. So if this just seems too much for you, don't worry about it. Just get in, buy good companies.
Yeah, and that is probably the number one thing that I can say. I want to say it was Warren Buffett and Charlie Munger. They're the two leading guys in long-term investing and value investing. And I think maybe 5 or 10 years ago, Warren Buffett came out with a quote that said Charlie Munger had completely changed his investment philosophy, because Warren's entire philosophy was to buy good companies at great prices. And he came out and he said he was wrong, and he's completely changed his philosophy. And Charlie convinced him that it's much better to buy great companies at good prices. And I completely agree with that. And I think that's what we're seeing today, or at least over the last few days in the market, is a lot of great companies are selling off. And I think you have a lot of opportunity to buy a great company. Apple, Amazon, Square, Facebook, Netflix, any of these good companies that have fantastic business models, you now have an opportunity to buy them at good prices. And I'm going to be taking advantage of that personally, because I think there's a lot of fantastic companies that are going to be much, much larger in a few years and have a lot more cash flow in the bank. And I want to be buying on these dips and buying them when they're on sale for my long-term portfolio.
Yep. I want to hold off on that a little bit. I want to dive into that a little bit later, but first I'm going to put you on the spot a little bit. I want to talk about what is the biggest mistakes that you've made in your career?
Twitter. I bought Twitter as my first stock at $44 in like 2014. And I was doing the math on this the other day. So I lost 50% on that trade. My first trade ever was Twitter. I lost 50% on it. It was absolutely terrible. I was doing the math on it, and after you take into account the splits that Apple stock has gone through, on that day when I bought Twitter, Apple stock would have been at around $18 after you take into account the splits, and now it's at 120 or 130. And Twitter just got back to $44 or $45. I don't know what it's at today. But I remember it was like 5-6 years later, and Twitter had just got back to the price at what I bought it in 2014, and Apple's like 6x higher. So biggest regret was I should have bought Apple as my first stock. It's also the stock that I recommend everybody else to buy. So buy your first stock, should be Apple stock, or it should be a company that you want to hold for the next 25 years. That's my first recommendation. Mm-hmm. And then my other big mistakes, I've made a couple. I've made a lot of big mistakes. I would say partnerships are really, really difficult, making sure you get into business with the right people. I've got into business with the wrong people before and just made bad business decisions, and it definitely comes to bite you. So I'd say be very, very careful with that. That was probably one of my bigger mistakes. And then after that, the younger you are and the more time that you have to invest, you have so much advantage. And so I wish that with the capital I had back in the day, I would have bought Apple, Google, and Amazon, because I'd be doing extremely well right now. And instead, I bought a couple of risky stocks. I did extremely well on some of them, and on a lot of them, I also lost some money. So I wish that when I started investing, instead of going after and trying to chase big returns, I wish I bought great companies at good prices.
Absolutely. I have a lot of the same experiences. I'll share one of mine. So first of all, my successful one, I bought Microsoft at like $24 or something like that back in like 2011. So that one's been great. Wow. But I remember a specific incident where back around that same time frame when the market was still trying to recover, and I was studying GE, the steady Eddie dividend paying GE value versus Amazon, which still wasn't making a profit. And I was like, GE, Amazon, I'll go with GE. And the dividends got cut like 6 months later, and the stock just has gone to hell over these years. And if I would have bought Amazon, I'd have been a lot happier right now. But you live and you learn, right? Yeah.
And it's one of those things where it's like, looking back now, the answer was so obvious, but as a new trader, when every stock is just a ticker and you don't know how strong and solid Apple has been over the last 20 years, like you just haven't watched it. So it's really difficult to pull the trigger in the beginning. But now, after I've watched Apple stock for 7 years, just steadily climb and increase, it's like, oh my God, like looking back, it's the easiest decision ever. And now I talk to, let's say I talk to my parents' friends or whatever. I know 2 or 3 of them that have built their entire retirement on Apple stock. So it's pretty crazy.
I will, before we go on, I want to say one more thing about kind of that topic is that, value versus growth. I think that, I made the mistake early on. I really gravitated to that value because there's this fear of loss, right? But if you're young, then you really need to go after those growth stocks because they're going to far outpace anything that you're going to get in dividends.
Yeah, if you're young, I highly recommend the growth stocks because I think there's a great opportunity there. You don't need the cash flow. Go out and get a part-time job and do whatever, because that's going to be the best investment when you look back on it 20 or 30 years later. Now, if you're middle-aged right now and you've got 50 or 100 G's sitting around that you need to invest, I usually lean a little bit more towards the dividend plays because that extra $500 or $1,000 a month just covers your rent payment, and it's going to be there 15, 20 years from now. And hopefully it grows probably at a slower pace, but it's also probably going to be a little bit more secure and steady than the growth stocks and with a little bit less volatility. So this is going back to what kind of investor are you and what is your time frame? Because if you're more focused on cash flow so that you can just pay for all of your expenses and park some money, then that's a very different type of portfolio than myself or somebody that's 30 years old looking for growth. So this is where it goes back to that key of what do you want? What is your goal? And then what are the realistic strategies that you can put in place to meet that goal? Like if you're looking for $3,000 a month of income, okay, no problem. You're probably going to need $1 mil or $2 mil and put it into dividends, and you'll be able to do that, no problem.
Mm-hmm.
But you got to have a strategy that outlines it and can get you there. And the growth strategies are sometimes a little bit harder to forecast.
Yeah. For me, I just rang in the big 40. So I'm still definitely in the growth quadrant. At least that's where I am. But over time, I might have to start transitioning that the other direction. We'll see.
Yeah, but like what's nice is you still have a full-time job and you're bringing in income, and so you're not relying on that money right now. And so growth is the fantastic place to put it. Let's say you break your leg next week or something and you can't go to work. Well, maybe shifting that into dividends to cover life expenses is better. So it really just depends on the situation that each individual investor's in.
Cool. Let's next talk about due diligence. You do a lot of great due diligence on stocks on your channel and also in your Discord. Plug for your Discord. But you recently had a video that I recommend everybody go check out that you talked about some of the things that you look at the most. And I kind of highlighted a little bit of them on the slide for those who are watching on YouTube. But talk about how you approach, should I buy the stock? Should I not buy the stock?
Yeah, no, I'd love to, because I think this is super important. And I think the first couple of points on here are what most people skip over. So when I go into due diligence on a company, or I say, okay, let's look at a stock, these are the questions that I ask myself. Number one, does this fit into my portfolio? If it's a dividend stock, is this a dividend portfolio? If this is a growth stock, is this a growth portfolio? You need to make sure that before you do any research and you actually jump into it, you need to make sure that this is a stock or a company that would actually fit in with your portfolio. After that, you need to ask yourself, is this a good industry? I know a lot of people that will not invest in alcohol, tobacco, or cannabis. And so you need to ask yourself, are you even open to investing in this industry? And then second of all, you need to ask, is this an industry that you actually want exposure to? For instance, myself, I don't buy or hold any oil and gas stocks because I think they're going to have a very difficult next few years. I think the world is transitioning to renewables and electricity. And I do completely agree that we're going to need oil and gas over the next few years, but I think the lowest cost producers are going to have the best chance at it. And it's just not an industry that I want to be in. So I don't do any due diligence on oil and gas stocks because I'm never going to invest into them. So I think these are the two first things that you need to look at is, does this fit in with me and my portfolio and my investment strategy and my beliefs? Because if it doesn't, then you're just wasting your time and there's no point.
So part of that good industry is looking at the TAM, the total addressable market.
Yeah, the total addressable market and then the growth rate is what I really like to see. Like, you want to be a company with an innovative product or some type of strategic advantage in an industry that's growing quickly, because then you've got the wind at your back, you've got an advantage, and now it just comes down to execution. And if you've got a good management team with a little bit of experience, those are kind of all the boxes that you need to check. And so that's where I start. And then, do they have a good business model? This is one of the things that once you get into an industry that you really need to look at, because I was the CEO of Burgundy Oak. And so what I think of when I go into a company is, if I was the CEO of this company, would I be really happy with my business model? and how would I sleep at night based on the finances. So if I'm the CEO of this company is on my shoulders, and these are my finances, would I sleep well at night? If you're Tim Cook and you've got $100 billion in the bank, you're going to sleep extremely well at night. But if you're Suncor, you've got some debt and you've got a couple of things coming down the pipeline and the cost of oil is dropping, then maybe you don't sleep so well at night. And so those are the things that I think about. And the business model is really important, because if you're Shopify or if you're Google, you have amazing, fantastic, like 95% gross profit margins. But if you're a company that sells a product that wholesales, you probably only have 10 or 15 or 20% gross profit margins. And so which business model would you prefer to have? So when I look at an industry, if there's a couple different business models and a couple different companies, I will usually choose the company with the best business model, even if in the short term it doesn't look as promising. That business model will usually make the difference in the long term. So an example of this is the drone industry right now. If you look at the drone industry, there's two companies that I really like. One of them is Drone Delivery Canada, and one of them is Dragonfly. The differences in these companies are absolutely massive. Dragonfly has a ton of revenue. They've got a bunch of customers, and they've got drones flying all over the US and Canada. Drone Delivery Canada has very little revenue right now. They don't have a ton of customers that are operating, and they're not doing a ton of flights right now. However, I like their business model 10 times better than Dragonfly. And so I took a position in Drone Delivery Canada first. So that's one example of the business model. And then once you keep going on this, it goes, how well have they done so far? And so this is where the due diligence actually starts. The first three questions on this slide are you literally just asking yourself, do I like this company? Does it fit in with my portfolio? And do I understand the business model? And is it better than the other companies? Those should take 5 minutes of your time. You should be able to answer those right away. And you should be able to decide, am I going to do more work on this? And then the work really comes into how well have they done so far? And that's when you look at the financials, you go through the statements, you go through the news releases, you look at the management interviews. That's where the work actually comes in, is on question number 4. And then after that, I talk about what are the risks. And so, competitors and substitutions. What does the competitive landscape look like? What does the regulatory landscape look like? That's really, really big for anything in cannabis, alcohol, anything health related, or biotech or drugs. Anything like that is highly regulated. So that's a big issue there. And then what does the future look like? Is this going to be an industry that's going to be bigger and larger in the next few years? Or is this something that's going to slowly die out over time? And then at the end of it, is this a good entry point? That's where the technical analysis comes in. So that's how I look at a company.
Yeah, I love it. I love it. And again, check out the video. He goes a little more depth and kind of talks about some of the tools that he uses to evaluate, to find the news releases, how to find the financials. So yeah, definitely recommend that. All right. Last up here, I just want to talk about some of your long positions. Put them on the screen here. Apple, drone stocks, psychedelics, technology. Let's just go through them one by one.
Yeah, so I'm pretty bullish on what we see on the screen here. I like Apple. I think Apple is a phenomenal company. It has dipped pretty drastically over the last few weeks. If you're looking for a good company to buy at a good price, Apple should be at the top of your list. They just had the best financials that I have ever seen in my life. I think they had the first ever $100 billion quarter. And this is one of the best run companies in the world, with I think the third or fourth highest cash balance in the world, that is continually pumping out better and better product. And I think the future looks bright for them. So if you're looking for a great company at a good price, Apple should be at the top of your list. And then Amazon and Google, if it starts to fall, I will be buying all three of those. Now, after that, I'm super bullish on drone stocks, psychedelics, and technology in general. I own 3 different drone stocks right now. I'm in Drone Delivery Canada, I'm in Dragonfly, and I just took a position in Archer, ticker symbol ACIC. They just signed a $1 billion deal with United Airlines, and it sounds like United Airlines is planning to partner with them more so than just be a customer. So I really, really like the drone space. I think it's going to make a massive, massive impact over the next 5 to 10 years. I think it's going to be a slow, gradual progression, but the ability to autonomously fly a drone instead of an airplane with 2 pilots and a runway and a tower and all the infrastructure needed, drones are definitely going to offset that market a little bit, at least in the short to medium range transportation.
And that ACIC, that's a SPAC, right?
Yeah, ACIC is a SPAC. that will be merging with Archer. So I don't believe that merger has fully been committed yet. But ACIC is how you'll get exposure to it. So
And
that's
psychedelics, why do you like that?
Yeah, so psychedelics. I got into this space pretty early. I got into mind medicine at like 60 cents. It's now trading at $4 or $5. So I'm doing extremely well on that one. And I really like this space because I was pretty early in the cannabis industry. I think I got in 2016, 2017 before it was legalized here in Canada. And I did extremely well on that. And I think the psychedelics is going to be kind of the second coming of that, more so on the medical side rather than the recreational side. But I think the impact that psychedelics and the medicines and the technologies behind it can have on the medical field is going to very drastically change how we deal with mental health, because the ability to provide natural ingredients that can make dramatic impacts on people's lives in a healthier way than a factory-made prescription drug is going to make a big difference. And I also think that they are much, much more effective at dealing with things like depression, anxiety, stress, PTSD, and those types of ailments. I think psychedelics has much more benefit than prescription medicine, but because of the recent situation with regards to the laws around psychedelics, nobody's been able to develop these drugs until now. And because of the recent law changes, both in the United States and in Canada, now we have the ability to develop these drugs. And I think it's going to drastically change how we deal with mental health. And in Calgary, the city that I'm in right now, we just opened our first treatment center for palliative care using psychedelics. So everywhere you look, this industry is blossoming pretty quickly, and it's growing extremely fast. And it's because these products work. Like, as crazy as it sounds, like these psychedelic products, I've talked to several people that will swear that these products have changed their life, and there's no shortage of those stories. And I think it's going to be a big trend. And there's now an ETF. So if you're interested, PSYK will give you exposure to, I think, like 12 or 15 different companies. All of them are pretty good. I think I hold 2 or 3 of them. And so I think psychedelics are going to be massive. And then technology has been the leader over the last 5 or 10 years. And I think it's going to continue to be the leader over the next 5 or 10 years, because you can scale up technology 10 times faster and easier than you can scale up a physical product. And that's the advantage with tech.
And obviously, I mean, technology, that's a really wide thing to just say, buy tech. There's good technology companies, there's bad technology companies. So is there kind of a sector you like? Is it, cloud computing or?
E-commerce and cybersecurity are the two areas that I'm heavily focused on. Etsy, Shopify, Amazon. I think if you could hold those 3 companies, and Facebook for the advertising, if you could hold those 3 or 4 companies, you have fantastic exposure to e-commerce technology. And then I'm a huge fan of cybersecurity companies. I think over the next 5, 10, 15 years, cybersecurity is going to be a larger and larger area of importance, especially for corporations and even for individuals, especially myself. Like, I'm showing people how much money is in my account on a YouTube channel. That draws a lot of hackers, and so cybersecurity is a big deal for me. And I think it's going to be an even bigger deal, especially as the world moves towards more digital assets.
I made a call at Cloudflare at $28. Sold half my position at 90. I think it's hovering around 74 right now. I still hold on to half of it, but they're a CDN company that's doing a pivot into more security.
It is. It's going to be absolutely massive. People don't realize it, and people don't think about cybersecurity until the hacks happen. That's the problem with it. But as these hacks occur more and more often, and more valuable information is taken, there's going to be a larger and larger pressure to have adequate security for your assets. And the companies in that space are going to do extremely well. So I like Palo Alto Systems and Fortinet are kind of the 2 main players, and I think both of them are very good. Okay.
Last thing I want to talk about is just the current, situation with the NASDAQ. You talked about looking for buying opportunities right now. When you predict, do you think that we're at, we've seen this kind of little correction and we're going to go higher from here, or do you think there's some more pain to be had?
I think anybody that tries to answer that question has no idea what they're talking about. And the best thing that you can do is prepare for both. And so for me, my plan is I'm going to be buying the dips and managing my risk with a stop loss. And so I'm going to be buying Amazon and Apple and Shopify as these stocks go lower. And I'm going to put a fairly tight stop loss on them when I enter, so that if the stock decides to move higher, then I've just bought in at some fantastic prices. And if the stock crashes or we go through an entire market crash, then I'm down a couple of percent and I'm not too worried about it. So that's how I'm going to be handling the market right now. As of right now, the NASDAQ, the S&P 500, and the Dow Jones are all higher than they were when we started the year, and Bitcoin is higher than it was at the high of January. So as of right now, we are not in a market crash. Anybody telling you we're in a market crash isn't looking at the charts. It's not to say that it can't happen or that it won't happen this week or this month or whatever it is, but as of right now, we're in a small pullback and not a market crash. Now, maybe that changes in the future, but for me, I'm going to be looking to buy great companies at good prices, and I'm going to manage my risk with a stop loss.
Sounds great. All right. Well, that is all the time we have for this episode. Zach, thank you so much for joining me this week.
Jason, thanks for having me. I really appreciate it, and I'll chat with you soon.
Yeah, man. Check out Zach's stuff on his YouTube channel and also at zachhartley.ca. Until next time, be smart, keep diversified, and stay greedy.
Follow Greed Geek on Twitter and Facebook at Greed Geek, and follow on Twitch at Greed Geek TV.